Hi, I'm Gary Flater with GaryFlater.com, and today we're going to talk about the lies Wall Street has been telling us. My goal has always been to bring Wall Street to Main Street, and I'm going to make a very bold statement today, and that's Americans have been brainwashed into believing that the stock market is always the place to be, even with the risk of its volatility and unpredictability. Don't get me wrong though, I do believe in the stock market, but I also believe in diversification. A well-balanced portfolio of stocks, bonds, money market funds, guaranteed investments, real estate, energy investments, as well as other alternative investments. Well, let's start with lie number one, and that is that you can get the long-term return of the stock market. Well, according to the research firm of Dalbar, in their 2011 study, they found that the average investors are still their own worst enemy. The study finds that investors' decisions are greatly affecting the returns. The results of the study illustrate a large difference between the performance of the S&P 500 average and what the average equity mutual fund investor has gained over the last 20 years. And that performance is as follows. The S&P 500 average has done 9.14% for the last 20 years. Yet your average equity mutual fund investor has done 3.2%. That 5.87% difference is what's being called the behavior gap. And that's investors letting their emotions get in the way of their investing behavior. And that's basically doing the wrong thing at the wrong time. If we can learn to avoid the emotions of investing, our overall performance is going to increase dramatically. Lie number two, annualized rate of return. Wall Street wants you to believe that the rate of return is all that matters. What we should be concerned about is the sequential rate of return. Here's a brain teaser for you. Is it possible to invest $10,000 and get a 25% average annualized rate of return for 4 years and still end up with the original $10,000? Well, if you answered no to that, then you failed this teaser. And here's how the answer goes. Your investment gains 100% in the first year and then goes down 50% in the second year. You do really well again in the third year and your money increases by 100% again. But again, you take that 50% loss in the fourth and final year. If you do the math, the average percentages added together divided by 4 equals a 25% return. Well, let's put some numbers into that so we can make it really stand out. Here's how the money would work out. Let's say you started with $10,000. Your 100% gain in year one increases that to $20,000. Year two, you lose 50% and you're back down to the balance of $10,000. Year three, your portfolio did great again and it earned another 100%. So now you're back up at $20,000 in that portfolio. But in the fourth and final year, we get that other 50% decline and we're back to our original $10,000. That's a 25% average annual rate of return. Hard to believe, isn't it? Lie number three, you must hire an expert. Well, 80% of mutual funds and investment advisors do not, I repeat, do not beat the return of the S&P, and most underperform the overall market. And many do so with considerable more risk. That doesn't mean you should not work with a professional. It just means that you need to do your due diligence. Ask questions. Analyze their performance. There are a lot of choices out there and a lot of good advisors and good mutual funds. You don't have to settle for less, but do your homework on that. Lie number four, investing and saving are the same thing. The difference between investing and saving has to do with the time horizon and the purpose of the money. Savings vehicles are traditionally a more conservative investment with a short-term time horizon and meant to be accessed for the short-term needs. Investing vehicles, again, are designed to be held long-term with potential for a greater return. They should not be considered accessible for current income needs. Like anything in our financial lives, we should be planning for our future needs and diversifying our portfolio or our nest egg, so to speak. And remember, speaking of that nest egg, don't put all your eggs in one basket. I'm going to close again with a quote as usual, and this quote's by Margaret Thatcher, and she said that pennies do not come from heaven. They have to be earned here on earth. And with that, I'm Gary Flater, GaryFlater.com. Have a great day.